tonight. Charlie, back to you.
Thanks, Jim. Let's bring in our market insiders, Kevin Kerr, editor and analyst at Global Commodities Alert, and Keith Wirtz, president, chief investment officer at the Fifth Third Asset Management, where he oversees the 4-star Morningstar rated Fifth Third Life Model Aggressive Fund. How did you come up with that name?
Well, we worked hard on it, Charlie, to be honest with you, but we're proud of it.
Okay, great. Well, let's start with you. You know, financials got crushed today, more than the market. What's going on with financials, and what's going on with Goldman Sachs?
When you look at Goldman, they're no longer an investment bank, Charlie. They're now referred to as a commercial bank. And the investment community is looking out forward in the next year or two, and they're looking at the idea that return on equity for these kinds of franchises are going to be coming down, probably for two reasons. There's not the leverage features that Goldman Sachs used to have, and there's probably going to be a dose of regulation they're not used to. And so as you look forward, their earnings streams are going to be coming down a little bit.
Kevin, let me ask you this. Why are the rest of the financials down so much? I mean, you know, Citigroup getting crushed today. Morgan Stanley, I guess they have some of the same problems Goldman has, but they do have a brokerage division where you think they can level out some of the earnings fluctuations. Why is the whole sector down this much?
I think everything is getting crushed off of fear. You know, we see these little rallies, and then we see an instant pullback. We see it in the commodities as well. You know, I think the money is coming in, but it comes in and it goes out just as quickly. I think people are very skittish right now. They've seen a lot of these big companies fold. Nobody knows what's coming next. It's like every day we get some new big bad news that nobody anticipated, and I think that's what's driving fear in investors right now.
But at what point do we believe that all of this is discounted to the stock? Because the fact of the matter is Goldman Sachs is right now approaching a level that we haven't seen since it went public. The day it closed, when it went public, years ago. So
1999.
Exactly. So Keith, at what point do you say, you know what, all of this is in the stock. We know that bank holding companies command a lower PE than investment banks once did. Time to buy.
Yeah, I agree. I think we'll see that point very soon. You know, I don't like to think about calling a bottom on anything, but when you look at GM at $3, Deutsche Bank saying go to 0, I mean, I had my aunt write me the other day and say, should I buy GM? You know, I think people are really starting to take a look at this stuff and say we may have thrown the baby out with the bathwater here. There's some good value in some of these stocks.
But isn't this like a negative to hear that American Express now wants to be a bank holding company? But it always owned a bank. Now it's a bank holding company, and it wants to tap the Fed window. Isn't that a little ominous that American Express, which essentially gives out loans through credit cards, you know, wants to be a bank?
You know, Charlie, the way I look at it, we're moving probably to a period of time before Glass-Steagall. We're not looking at investment banks and commercial banks. We're looking at just diversified financials, much like pre-Glass-Steagall of the 1930s. And I think that's where people have to situate themselves in the finance sector. And maybe one other thing I'd add earlier to Melissa's question, I think the markets recognize that there's more bad news on the horizon, whether it's economic or on the earnings front, and the market's trying to sort and calibrate all that bad news on the horizon, and no one wants to take risk at this point.
Kevin, let me ask you a question about Warren Buffett and Goldman Sachs. He put money in there. His investment is down nearly $2 billion. What do you think is going to happen to that company and to his investment?
Well, I think if anybody can handle that kind of downtrend, it's going to be Warren Buffett. I don't think many of us could handle that kind of a pullback. But longer term, obviously, he sees there's value there, as I was just mentioning a minute ago. I mean, the people that can ride through this rough and choppy seas, if you can handle the risk management, then they're going to probably do well.
Do you see value there? Do you see value that you think it's going to ultimately out?
I do, but I couldn't ride that kind of risk, as was just pointed out. You know, that kind of risk is just too much for us. We couldn't take that on.
I mean, there's all kind of talk about restructuring there, possible partnerships with other financial services company. Charlie, you've been following it.
Well, let me ask you this, guys. Do you think that Goldman Sachs is going to become a private company? It's been a public company since 1999. It's done very well. It's not doing so well now. What are the chances it becomes private?
I'm not sure what the chances are that it might go private, Charlie, but the one question I keep asking, at what point do they step up and actually try to buy a commercial bank somewhere in the United States?
Well, what's out there? There's not much out there.
Fifth Third is out there.
Well, that's right.
You know, but are they going to start a strategy towards building a deposit base where they can anchor, you know, with the low-cost funding like a commercial bank? That's one of the questions I keep asking myself. Well, when do they become a buyer of other commercial banks?
Let's take a broader market perspective. We have just a couple moments left. Keith, let's start off with you. Where do you see opportunities? If you're not quite ready to call the bottom in the financials, what are you buying right now?
Well, we think the investment attitude right now is to avoid risk. You want to stay where there's predictability, and so we're playing defense in the stock market. We're looking at companies like McDonald's, Rabbit Labs, where you've got predictable cash flow, predictable earnings on the horizon. We don't think it's time yet to play higher beta kind of situations until you get some of this bad news that we see on the horizon embedded in the marketplace.
And Kevin, what's your playbook?
Well, commodities are my bailiwick, and when you see China spending 4 trillion yuan on infrastructure, base metals are going to do well longer term. Energy is certainly going to climb. I don't think that oil at $60 is a great short position to have, and I think the markets reflect that. OPEC has said they will cut more at that level, and so there's really more upside to this market than downside in the energy.
All right, Kevin, thanks very much. Keith, Wirtz, thank you very much to both of you. Up next,